A philosophy teacher asked a student to sum up Socrates' life in 4 lines. Here's what he said. Socrates lived a long time ago. He was very intelligent. Socrates gave long speeches. His friends poisoned him. Winston Churchill once cautioned an audience saying, quote, "I'm going to give a long speech because I haven't had time to prepare a short one. For your sake, I've had time to prepare a reasonably short one. Yet, it will include Graham and Dodd pedagogy many of you have encountered. As Mae West observed, too much of a good thing may be wonderful. We'll see." As Prem said, Southeastern Asset Management is a long-term, concentrated, engaged value investor. And we believe it's imperative to get economic incentives properly aligned, to compound capital most productively with the least risk. Co-ownership eliminates conflicting interests and best achieves return objectives. The concept of investing in partnership with our clients and our investees' managements is important to us. Between our 2 private foundations, our retirement plan, and our associates' capital, we are Southeastern's largest client. Long-term. Being a long-term investor has distinct advantages. It reduces the number of decisions one must make. It allows you to focus on high-probability investment outcomes. It minimizes frictional or transactional cost. And it defers or eliminates tax liabilities, leaving that capital to compound for you. Additionally, being a long-term investor puts you in the tiny minority of market participants where there's less competition, where you can concentrate on companies that will deliver much more free cash flow per share in 3 years, while others are trying to guess next quarter's EPS. Over our 43 years of operations at Southeastern, we've held our investments an average of 5 years. Concentrated. Since Southeastern was founded in 1975, our portfolios have owned 10 to 20 investments, depending on diversification mandates. And we've always believed a prospective new investment commitment had to be materially and demonstrably superior to our least qualified holding in order to supplant it. Adding a marginal name to a defined limit of portfolio holdings pushes you into the world of, quote, diversification. We've practiced Warren Buffett's admonition, don't put too many eggs in your basket and pick them carefully, and agree with his declaration that, quote, diversification is protection against ignorance, but if you don't feel ignorant, the need for it goes down substantially or dramatically. John Maynard Keynes, who had a spectacular investment record managing several insurance company portfolios and the King's College Foundation, addressed concentrated investing writing. To suppose that safety first consists in having a small gamble in a large number of different directions, as compared with a substantial stake in a company where one's information is adequate, strikes me as a travesty of investment policy, end quote. But to be a successful, concentrated, risk-averse investor, you must think independently, do your own appraisals, exercise incredible patience and discipline, be willing to hold cash, and then be courageous enough to go all in when you find a true investment qualifier. Most often it's when almost no one agrees with you. And you must be unafraid to look stupid in the short run. I'll address important investment qualifications a little later. Engaged. We believe it's incredibly important to be engaged with our company's managements, not only to support them when it's warranted, but to help them make intelligent capital allocation decisions. Wise deployment of a company's cash is a paramount necessity to achieving an acceptably profitable long-term investment return. A bond analogy highlights the magnitude of the reinvestment function. In Sidney Homer and Martin Leibowitz's preeminent Inside the Yield book, the authors dissect the three components of a bond's yield to maturity: the accretion of the discount, or the amortization of the premium to par at maturity, the coupon, and the interest on the interest. By way of example, and to keep it simple, assume you buy a 10-year, 8% high-yield debenture issued at par and hold it to maturity. Many would believe you'd earn an 8% yield to maturity. As Homer and Leibowitz explained, that's not the case. In order to earn an 8% yield to maturity, each of the interest coupons must be reinvested at 8%. If you put all the interest payments under your mattress, your compound return drops to 6.1%. If the coupons are reinvested at 12%, your compound return, or your yield to maturity, rises to 9.5%. So with the same bond, two investors can reap very disparate returns: 6.1% versus 9.5% in this example, for a 55% differential in results. The ultimate yield to maturity, therefore, depends on the reinvestor and the profitability he or she, and how profitably he or she redeploys the coupons. There are three identical components that determine a stock's compound return: the accretion of the discount, or the amortization of the premium to intrinsic value, the company's free cash flow coupons, and the interest on the interest, or the return an investor receives from the free cash flow that is reinvested. Management has 5 capital allocation choices: dividend distribution, debt repayment or additions to liquidity, growth CapEx, acquisition, or share repurchase. Each must be weighed considering the risk and return potential, and we believe should be justified against share repurchase, especially when a stock sells below its intrinsic value. I can assure you that the largest owner of Berkshire Hathaway has been maniacally focused each day since May 10, 1965, on the importance of the reinvestment component of compound return. Ben Graham wrote about the responsibility shareholders had to hold managements accountable for their capital stewardship. We are engaged with our company's managements to encourage and promote sagacious capital allocation decision-making, and because we believe it's our fiduciary duty. Prem Watson needs no encouragement. If Fairfax Financial uses all its free cash flow over the next decade for share repurchases when its stock's below fair value, as Prim indicated they would do in this year's annual letter, Fairfax is likely to be Toronto Stock Exchange's number one performer over the next decade. Value investor. In 1997, Barron's Magazine summarized our value investing approach in their lead article entitled Business, People, Price. Said differently and more in Ben Graham's vernacular, we believe every investment must qualify quantitatively and qualitatively. Quantitatively, as many of you know, we've always required our investments to have a significant margin of safety, or ones where we receive much more intrinsic value than the price we're asked to pay. Keeping in mind that intrinsic value represents all the future cash an investment will produce or could be liquidated for, and that book value reflects all of the company's past retained earnings. We assess business value by summing up current net worth of the assets that they have, the liabilities. Secondly, using appropriate comparable sales, and we've maintained a comparable sales database for some 4 decades plus. Or lastly, and most often, applying our discounted free cash flow valuation methodology. A DFCF appraisal is only as good as the certainty of your model's future cash production inputs. It's our strong opinion this tool should be used only for understandable, competitively advantaged companies whose future cash production is reasonably predictable and assured. A quantitative appraisal is a mathematical conclusion based on qualitative factors because every cash production and reinvestment assumption in a discounted free cash flow model is entirely dependent on the quality of the business and the quality of the people that produce the free cash flow and reinvest it. It is why the appraiser's job is to try to get the value, quote, approximately right instead of precisely wrong. It is why you need a large margin of safety of value over price in case you are wrong. It is why the qualitative characteristics are more important over time than your going in P to V or price to value. Qualitatively, as we've discussed, the people must be accountable, good capital allocators. They also must possess the operating skills needed to produce a growing stream of cash. And needless to say, be most ethical, shareholder-oriented, partner-like owner-operators. To amplify earlier comments, the best form of management and shareholder partnership alignment is where the CEO works for free and owns a lot. We completely agree with what Arthur Rock, the most renowned and respected venture capitalist, said when handicapping a new venture's prospects. And I quote, "Great people make great companies." Will Thorndike's The Outsiders chronicles 8 great CEO corporate value compounders and their constant, disciplined, independent, and intelligent decision-making who were always focused on prudently building their businesses' intrinsic value per share. Southeastern was fortunate to be a co-shareholder with 7 of these 8. The Outsiders is third best investment book we've read, exceeded only by The Intelligent Investor and Security Analysis. And we commend it to all of you if you haven't had a chance to read it. The qualities of these CEOs and the returns they delivered make it clear how important partnering with top-drawer, competent corporate stewards is. Qualitatively, the business must be competitively advantaged if you expect it to earn high returns on capital and to grow its value above your discount rate. An inferior company with the best CEO in North America, even purchased cheaply, is unlikely to outperform for any extended period of time. It's why time is the friend of the good business and the enemy of the bad. The good business will produce more free cash flow than its cost of capital and accrue and grow its value. The bad business will not earn its cost of capital and thus will be slowly liquidating. So if you buy a bad business materially below its liquidation value, you better be prepared to get that value quickly because it will be lower in the future. Michael Porter's book, Competitive Strategy, provides a terrific framework for assessing a business's durable and long-term advantages. Barriers to entry, what are they? Scale, brands, high switching costs, limited distribution channels, and how strong are they? Rivalry among competitors, how intense is the interplay between companies? Rivalry increases with a slow-growing industry, high fixed cost structures, low switching costs for customers, high barriers to exiting the business, or if competitors have similar strengths. Substitute products. Are there other types of products that could address the customer's needs? For example, if airlines raise prices for business travelers, will they use another mode of transportation or substitute teleconferencing? Strength of buyers. Do the customers have more power than the company? Does the product represent a significant portion of the customer's cost? A single customer comprise a large percent of the business? Or switching involve low cost or minor changes? Strength of suppliers. Who has more bargaining power is determined by the importance of the relationship to each player in size, product, or switchability. In conclusion, successful investing, i.e., successful capital compounding, depends on a growing stream of future free cash flow coupons, the smart reinvestment of those cash coupons, and the accretion of a stock's discount to its intrinsic value. All three of these components of compound return depend on the quality and the capability of the business and the people. We're concentrated and engaged to help assure that all three of these components of compound return work in our favor. Finally, I'll close today's prepared remarks with complimentary and wise advice from author Texas Bix Bender, who wrote, "Don't squat with your spurs on." Honesty is not something you should flirt with. You should be married to it. No matter who says what, don't believe it if it don't make sense. Too much debt doubles the weight on your horse, puts another in control of the reins. Sometimes the quickest way to double your money is to fold it over and put it in your pocket. Always drink upstream from the herd. Coolness and a steady nerve will always beat simple quickness. Take your time, and you'll only need to pull the trigger once, maybe in a lifetime 20 times. So, from this point, you're spared of prepared remarks, and we'll try to answer questions the best we can. We'll carry on until George cuts us off.
Okay. What is the mics? Mics, students, where are you? What happened? Okay, we need another mic from there. Okay, there. Okay, Laura, you got the mic there? There were two mics. Where's the other one? Okay, a question over there. Yeah, Laura, go and get the other mic.
Hey, thanks, Mason, for the talk. And can you comment on the reinvestment decision of CenturyLink, since it's your largest holding? They have a pretty high leverage, like a $40 billion debt, and have like a capital marketization, like $20 billion. They pay like over $2 billion dividend. What do you think is better to use the dividend money to pay off the debt a little bit, to do reinvestment, because you have a lot of great opportunity to build the intrinsic value? Can you comment on that?
You said CNC, did you not?
CenturyLink.
Oh, CenturyLink.
Yeah.
Okay, I'm sorry. CenturyLink. CenturyLink is an extension of our long investment history with the great fiber network company Level 3. CenturyLink was the owner of Quest, which was another very significant fiber optic backbone company. And Level 3 had tried to buy Quest, but it never worked out because of various prices of the two different currencies, two different securities. So basically, we did the merger in reverse. We sold Level 3 to CenturyLink, got directors, and are partners with terrific other shareholders. And as we put the two companies together, we did a lot of work and determined there was about $950 to $1 billion of cost and capital synergies. Before any of those costs or synergies, there was about $8.8 billion of EBITDA, 5.6 from CenturyLink and 3.2 from Level 3. So total of $8.8 billion of gross operating cash flow. We believe they'll get about $400 million cost out this year, 2018. So that then therefore gets your cash production to about $9.2 billion. There is CapEx of 3.8 and interest expense of 2.1, which leaves above CapEx and interest cost $3.25 or so billion of free cash flow. The dividend is $2.16. That $3.25 billion of free cash flow is spread over 1,064 million shares. So on a per share basis, there's about $3.10 or so of free cash flow before a $2.16 dividend, $2.16 dividend. So there's, in round figures, almost $1 of free cash flow after the dividend. And we will obviously take a look at that. The company, the board will, and we will hopefully deploy that most intelligently. I can share with you that it's probably not even a discussion that the shares are the most opportune value per share creating capital allocation choice. So yes, we look forward to what they have to say about their progress since we were last in discussions with public information, and that'll be forthcoming in a week or so. So it'll be great to get a report from Jeff Story and Sunit Patel. And Jeff has been made CEO earlier than announced previously. He and Sunit have a spectacular plan for getting the cost and the capital efficiencies that they have telegraphed.
Another question. So, Craig, there are two people here. Can you raise your hand, please? Okay. And then over there.
Hi, appreciate your comments. You've obviously been a very successful long-term investor, well noted, but when I look at the performance of, for example, your partners fund versus the S&P, and people have talked about, long-term, et cetera, I mean, it's significantly underperformed for a 10-year horizon versus the S&P. So my two questions would be, one is, what do you think long-term is today? And then how does that speak to how challenging value investing has become in the last 10 years versus maybe a period in the 70s and 80s when there weren't so many hedge funds or other people out there trying to, suss out ideas and to compete against?
Well, I will speak to it kind of derivatively. We love what we own. We've compounded at good absolute returns, we believe, with low risk. We're very happy at our foundation, our retirement plan, and from our personal capital standpoint about the absolute returns that we posted. We have not been willing to stretch for the five largest market caps in the S&P 500, if that's your bogey and your benchmark. And we are unabashedly not apologetic for not participating in some of these things that are outside of our circle of competence, if you want to be truthful about it. It's one of our 8 or 9, I guess it is, 9 publicly offered funds. And we would say that the other 7 have performed better on market indices relative basis. But no, we're very, very excited about what the Partners Fund owns, many of our most substantial commitments, and they are beginning to pretty significantly outperform in the last weeks or so. But it's high time, I guess, for those that focus on the market as a benchmark.
Okay, there was one question over there.
Yes, hi. I'm curious, coming back to the valuation, you sort of mentioned that there was a database that was built over a few decades, the 40 years of the firm. And so I'm sort of curious to know, what led you to build that database of transactions or M&A or private market values, and how you see that differentiated from what someone can find on Bloomberg today?
Well, we did it mostly ourselves. Early years, we have a person assigned to it today. So every going private, every merger, every acquisition transaction is recorded, and we have specific things that we record. Price to revenues, price to operating cash flow, price to whatever the industry units are. If it's timber, it's per 1,000 board feet or per ton. If it's oil and gas, it's per MCF per barrel. If it's media, it's per subscriber, what have you. So we're recording all the necessary metrics that we can then use so we can then compare one of our future potential prospective investments to what's going on. It's very important, however, to adjust all of these comps for the interest rate environment in which they occurred. So, a merger or an acquisition that occurred in 1982 when the 10-year Treasury was 15%, is going to be or warrant much lower metrics than a transaction today when the 10-year is bouncing around 3. The comparable sales database is one yardstick we use. As another, we always do some of the parts net asset value based on today's economic values. And then, as we said in our presentation, thirdly, for those that are subject or warrant DCF approach, we apply our DCF models. I might add a little more color on a discounted free cash flow model. You want to be conservative with all of it. First, say no to DCF model if it's not, as we said earlier, predictable, reasonably assured cash production, and yet in the model itself, you want to start with the current free cash flow coupon. Many don't even know how to do that, so you need to go through, all the cash that comes in the door, the gross operating cash flow, all that goes out in terms of maintenance, CapEx, working capital needs. So you start with net income and add depreciation, depletion, amortization, deferred taxes. Then you subtract out, those things that go out the door in terms of maintenance, CapEx, and working capital needs to come up. Make sure that you're being conservative on what the free cash flow coupon is today. We take it out never more than the historic growth for maybe 8 years. We put a terminal multiple on it, not more than, say, the GDP kind of growth. And then we bring it all back for us at a 9% or so discount rate. Why 9? Well, we believe businesses are risky, and we need to earn that kind of return for us to push money out and feel comfortable that all the risk, and we're not talking about risk as defined as stock price volatility, leverage, competitive threats, legal threats, what have you. So we think about owning the business in its entirety and what might harm it is the way we think about it. So, 3 ways to kind of try to hang a number on a business. Comp sales are helpful. Sometimes some of the parts are the way to go. We've had a long and great history of looking at multi-industry companies. Where the market gets overly focused on, say, one division or one subsidiary, and they penalize the whole, and they're very valuable in discrete parts. And that's a field that we love. It's not necessarily that complex, but many times the focus is incorrect in the daily voting of Wall Street. The case of CenturyLink today is a great example. Wall Street is comparing the greatest global fiber network in the world with its security and ability to connect people globally without hacking risk and fears to two runoff twisted pair of copper old line telephone companies in Windstream and Frontier. There's no comparability. And so, it is interesting how sometimes myopic and simple the investment world can, or the capital allocating world, most of which we would not, under Ben Graham's definition, call investors, but speculators in many cases. Yes?
Thank you. Have your thoughts on technology stocks changed over time? And, one of your holdings seems to be from the tech sector. If you could, share your thoughts on what attracted you towards that particular company versus others in the sector.
Now, which company are you referencing?
I am referencing Alphabet.
Alphabet.
Yep.
Whoa. Alphabet, as you know, formerly was named Google. We had a long and very, very successful investment history in the advertising agency world. Ogilvy and Mather, and then got it sold for 2.5, 3 times our cost. J. Walter Thompson, a similar case. Google is by far and away, first mover advantage using search to direct ad dollars to the most relevant in market. The company, as you know, founded by Larry Page and Sergey Brin, has become a juggernaut. In many ways, almost a global monopoly. So we look at it not necessarily as a tech company, but an advertising vehicle, and our purchase price is determined by revenues, operating cash flow, and operating free cash generation, and what they can do with it, and the reinvestment of it. As you know, they're not big dividend payers, they're not big and significant share repurchasers, and their little foray into a company called Verily. I can barely remember it. It was so insignificant in our spreadsheet because there was zero value attributable to it. It was rumored that they just sold a 1/8 interest in Verily to one of our sovereign investment partners for $1 billion, thereby assigning $8 billion to this particular company. When we first were involved with Google, there was almost no value attributable to YouTube. We didn't know the value of Android. We didn't know the value of about 6 other nascent, early stage ventures. So most of that we get on top of our appraisal that we don't really have a definitive way to tell you what they're worth. We believe that they're very, very smart programmers working on things like anti-aging, working on AI, on cloud computing, on all of these things that are separate and apart and very valuable from the basic advertising search business. We have a $1,300 appraisal that does not include this myriad of other things that I haven't even mentioned. Waymo. Waymo is Google's driverless car effort. Waymo has as much as 3 or 4 times more miles driven than any other software effort. I have a daughter that lives in Palo Alto, and she's been sending me pictures of these cars driving around with no driver for about 6 years. And there are many difficulties in this driverless world that we're going to enter. The first one was when the car puts on its brakes ahead of you, red light flashes. There could be a stop signal above the car that also has a red light. The computer has to determine whether it's the car slowing down or whether the light's about to change. Those are really, we take them kind of for granted, but you can't take them for granted if you're not going to have a driver in the car. So anyway, how much is Waymo worth? We carry it at 0. So all of these little facets of what's now, quote, Alphabet are our chicken way to play the evolution of brilliant technologists and what's going on out in their world. So, yes.
Hi, Mason. Thanks for taking my question. I'm a very large shareholder of Fairfax. You're a much larger shareholder than I am. The last 6 months or 9 months in the valuation of Fairfax has been mind-boggling to me. I've owned the company off and on for the last 20 years. In the last 6 months, the opportunities for value invested by Fairfax have been simply spectacular at a number of 105 or 110% of book value. Since that time, XL has been taken out at 150% of book value. Markel continues to trade at 160 or 170% of book value. We have a spectacular balance sheet with outstanding optionality due to the large cash balance and the opportunistic sale of all the long bonds when Trump got elected. We've got great corporate governance. We've got a great portfolio of international insurance companies. So my question to you is, in a world of a lot of smart people, this is not an unknown company. This is a well-known P&C company with a great history. How do you describe and how do you think about how the discount has existed in the last 6 or 12 months?
We're just grateful it was undervalued, underpriced. Yeah, Fairfax is one of our largest commitments. It's top 5 probably across most of our mandates, U.S. large cap, global, international. It exemplifies those business people price requirements, quantitative, qualitative characteristics that I've talked about. It's great to know where most of the free cash flow is going at these price to value metrics that you referenced. We'd like it to stay cheap a long time. We'd like to be the last remaining shareholder with Prim. You can do the calculus, and the longer it stays cheap, the more return we get at the end of the day. So, no, it mystifies us why certain things get disdained and others are loved to the end of the earth. But it's not for us to judge what others are doing, but to be intelligent about what we're doing. I think that there are 2 or 3 things that won't be said maybe by Prem or his management team. They've developed what I think is most valuable that's not on your price to book or your other references. And that is just an incredible culture. And culture's everything when you're giving the pen to some of your partners. It's back to patience, discipline, and waiting until the price is right. And that pertains to taking on big catastrophic or property insurance risk, or whether you're investing in a common stock or a bond. I will say that they've been patient and disciplined, and they have last public release about $20 billion of cash and another $9 billion of very short-term, high-quality debt instruments, so almost approaching $30 billion of what we call going on offense firepower. And the ability to create future value at Fairfax is significant. And they have been some of the wisest long-term lenders I've ever seen. I was way nervous, way earlier than Prim became nervous about all the long bonds and the leverage of that long bond portfolio, and they literally exited that whole program at the right time and have been patient, waiting in very high quality cash equivalents with a lot of additional liquidity at their fingertips when something. And they've been terrific on putting some of it out in smaller amounts, but I am very convinced that given today's volatility, I mean, we've had about a 600-700 point Dow swing just today. You'll get, if you're patient, disciplined, and prepared, you're going to get a chance to put this money to work at high returns and low risk. And that is what we've given proxy to at Fairfax. it's hard to find. They would, in Will Thorndike's book, The Outsiders, that I talked about, he does these 8 wonderful case studies of people like Bill Sterritz of Ralston Purina, Katharine Graham of Washington, former Washington Post, and 6 others that we were shareholders with. And we are not only admirers of Will Thorndike, but we're good friends, and he is now chairman of the board for one of our significant investments, CNX Resources, which is the low-cost producer of methane in, we think, the world, because they own their land, fee-based land, so they don't have to pay 20% royalty to others. So their competitors are all paying that 20% off the top to others. Well, Will is the chairman of this company, and we challenged him to allocate capital as intelligently as the people that he referenced in his book. So, but the point I was going to get to, when you read his book, you'd say, well, that's great. You guys made 5x at Ralston, or 4 or 5x at General Cinema with Dick Smith, or XYZ at some of those other examples. And what we've done is we've started creating a list of the next 8 companies for Will Thorndike's next book. And we won't tell you who those are, but a number of them are represented in our portfolios, especially in the both the global and the international. So they're potential wonderful, smart business partners, and it takes a while to make up your mind that they are as good as their record indicates. You want to see how well they've operated and done all the things that you learn about in business school to produce the cash coupon, but then how they've worked to put it to work for you, for all your shareholders, our clients, et cetera.
So is that a last question?
Yeah.
Okay, last question over there. Andy over there. Or Laura, you can get.
Yeah.
Thank you for coming by.
Yes.
Can you talk a little bit about Allergan?
Allergan?
It's in your portfolio.
No. We're not going to talk about that one right now. A lot of reasons. That's not to say we won't talk about something else, but not Allergan.
You have another question?
Which one? Park Hotels. Yeah, we'll touch on it. As you know, we became their largest shareholder when the Chinese were forced to divest, their former Hilton investments, of which Park Hotels was a spinoff of their U.S. properties. Their values are in order of magnitude. Hawaiian Village, the most valuable hotel complex in the world. They've got key hotels in San Francisco, other major cities in the U.S. They own a key hotel in New York that is arguably more valuable as office. And so that's one of the things that we are working on. Tom Baltimore is the partner. He's terrific. He's had a long and storied history of being a very good manager of high-end, larger properties, hotel properties. It's got an excellent balance sheet. It's a REIT, so that the cash flow goes out directly to the owners. It was a very compelling dividend yielding, high certainty, cash producing set of assets at 25. And I think it's up to 28.5 now. So business people in price were interesting to us, even though we are somewhat late in the hotel cycle, but we see very little pressure on their biggest components of our appraisal just because they're supply constrained. Anyway, George.
Thank you very much, Mason.
Thank you. Yeah.